Hey there, I hope you're doing great. It's Matt Rinke with Illumination Wealth Management. And as you probably know by now, it's been a rough couple of weeks in the stock market. I know I've spoken to many of you over the last several days, weeks, and months talking about how something like this would not be unexpected. And I think it's appropriate right now to put things in perspective. You see, global stocks have declined about 6.5% over the past 3 weeks. And so for this, you wouldn't even call it a bear market. Technically, that doesn't even happen until a 20% drop. And so we have a long ways to go until we get there. And so there are a few things to remember at moments like this. Firstly, it's much more important to keep your cool as an investor than to be a cool investor. And you need to remember that you're not investing your money for a day, a week, a month, a year, or even a decade. Your retirement and financial independence portfolio likely will not be used for decades, and even after you start spending it in retirement, you'll do so over a 20 to 40 year financial life. So a 2-week, 3-month, or short-term period in the market almost has nothing to do with what your portfolio eventually be worth when it comes time to spend it. Number 2, stocks are risky. Stocks have a habit of losing a good amount of money in a short period of time. And those who invest in stocks need to realize that this is completely normal. It doesn't feel normal, but it is normal based on market history. This is the reason why stocks return more than other asset classes over long periods of time. And John Bogle of Vanguard likes to say, if you have trouble imagining a 20% loss in the stock market, you shouldn't be investing in stocks. So also, it's very important to diversify. A 100% stock portfolio would have lost 6.5%. But if that portfolio had half of it in bonds or conservative assets, the portfolio would have only been down about 3 or 3.5%. So bonds and conservative investments, even if they're quote unquote in a bubble like people say they are now, do have a valuable place in your portfolio. Additionally, you want to make things automatic. Invest systematically and invest when you have the money. Have a written investment plan and rebalance your portfolio according to your investment plan at pre-specified intervals. Beyond that, you need to remember that you cannot predict the future, nor can anyone on TV or any newsletter that you receive, and you can't yourself. And so if you think you can, I would challenge you to write down your predictions and then look back at them in a year, 2 years, 3 years, and really see how they did. I think you'll know you'll be giving up that guessing game very soon. And don't forget in periods of stock market declines to tax loss harvest. This can be worth its weight in gold and defer taxes on those gains in the future. And the last thing I want to talk to you about is sticking to your plan. It's so much more important as an investor to stick to your plan than to abandon it on an emotional basis simply because there's volatility in your portfolio. Risk is not market fluctuation. Risk is not reaching your goals, or risk is running out of money when you actually need the money. So I hope that you can continue to keep your cool as an investor and give up trying to be cool as an investor. I can help you with that. I would say sign up for our newsletter at www.illuminationwealth.com so you can be plugged in and have rational, intelligent investment decisions, and will help you with your investment behavior throughout your entire financial life. I appreciate you taking the time to listen. Hope you have a wonderful rest of your day. Talk to you soon.